You may have noticed recently the amount of media attention around the threats of rising interest rates and the effects it has on our overall financial wellness. I think you would agree with me that now more than ever the wisdom of having a sound mortgage strategy is very important. I think many people have the idea that this new threat of rising interest rates has no effect on them if they are currently in a locked-in mortgage. The truth is, if we pay attention to this threat today and act accordingly, we have significant opportunity to save thousands and thousands of dollars and shave years off the time it will take to pay off our mortgages. This video is just over 10 minutes long, and I would encourage you to watch it to the very end. You will see an example of how you could shave up to $21,000 off the principal of a $200,000 mortgage over the next 10 years by executing our very simple yet effective strategy and taking advantage of an incredibly rare opportunity to lock in your mortgage for the next 10 years to protect yourself from the certain threat of rising interest rates. Please feel free to comment in the box below. Right now we have a rare opportunity to take advantage of the full benefits of a 10-year term. More importantly, for you to consider taking advantage of our 10-year fixed mortgage strategy, you will need to believe that interest rates are in fact going up. Notwithstanding the headlines I've showed you in previous slides, and these days seems to be more and more, let's take a look at some facts from the Bank of Canada website. This chart shows a comparison between the 5-year fixed rate and the Bank of Canada prime lending rate over the past 25 years. When you review it closely, you will see that every period of low interest rates is followed by a significant quick increase in rates. This happens because the government uses the prime lending rate to help curb consumer spending and manage inflation. When interest rates are low, Canadians spend more, which often, among other things, causes inflation to rise. The Bank of Canada's primary mandate is to keep inflation in check. When inflation rises, then they tend to increase interest rates relatively quickly to temper our spending and, more importantly, our borrowing. The economy slows down and the risk of inflation lowers. Now, with that said, multiple bank economists, the Bank of Canada governor, the guy who ultimately sets the rates, the finance minister, and even the prime minister have been very clear with Canadians. They've all told us that the interest rates that are currently available today are considered emergency rates to get us through the recession, which means they are only available to help stimulate the economy, and as we see from the graph, they will eventually increase. Every recession in history has a recovery, which for certain brings with it higher interest rates. This is where the challenge comes for Canadians who are currently in a locked-in mortgage. Do I jump out now and early renew into a mortgage to take advantage of today's lower emergency rates, or do I roll the dice and hope that rates will stay low when my mortgage renews in 2 to 3 years? The answer is increasingly risky when the typical mortgage option people consider these days, if in fact they do renew their mortgage early, is a 3 to 5 year term. Of course, this means I'm just setting myself up for additional risk when my mortgage renews in 3 to 5 years at certainly more normalized rates of 5.5% or more. To fully form our thinking around this strategy, we should consider the question of how high could interest rates rise. You can see the average variable rate mortgage over the past 25 years is 4.09%, and the average 5-year fixed mortgage is 6.72%. And as of the shooting of this video, the 10-year discounted wholesale mortgage rate through our office is 3.89 to 3.99%. So let me paint you two simple scenarios to consider. Let's say you have a $200,000 mortgage which you took out a couple of years ago to take advantage of the excellent low emergency rates. In 3 years, when your 5-year mortgage comes up for renewal, at more normalized interest rates, your monthly payment could increase by as much as $328 or more. This is called a payment shock, and yes, it catches many unsuspecting Canadians off guard. What if you took your mortgage out 4 years ago when unfortunately you missed the emergency rates? The 5-year discounted mortgage rates in early 2008 were around 5.5%. By the way, this should give you another indication of the possibility that interest rates will likely be in the mid-5s or higher, since that is exactly where they were right before the recession. You might say, I'm about to hit a windfall when renewing in the next year or so into current 5-year rates, which are in the mid 3% range or better. I encourage you to consider something. You will not only be facing a nasty payment shock at renewal, however, you do have a significant opportunity to take the lower rates of today, implement our inflation hedge mortgage strategy, and shave years and years and years off your mortgage. Check the number below and give us a shout to see how. Let's take a look at what you might get for rates these days. I encourage you to consider that these rates are financial traps that are going to lead you into renewing your mortgage in the heat of increasing rates in 4 to 5 years. I think the most important part of this presentation for us is to carefully consider the current spread between wholesale 5-year fixed and 10-year fixed rates. Never before in history has the risk premium to take another 5 years of protection against long-term rate increases been this low. There is currently around 0.60% between the 5-year rate and the 10-year rate. This is unprecedented and deserving of a very hard look at the wisdom of considering acquiring this extra protection. I think you would agree with me, regardless of what rates may or may not do, the peace of mind of protection for such a small premium on rate is worthy and certainly very compelling. Let's walk through an actual example. If you were to take a 5-year mortgage today, let's say at 3.39%, with a standard repayment, you would pay it down to $178,979 in 5 years. If you were to consider opting for a longer term security against rising rates and chose a 10-year mortgage at 3.99%, coupled with our inflation hedge mortgage strategy, your balance at the end of 5 years would be reduced to $176,976. Therefore, with the plan we have laid out for you with active and ongoing management, we could actually save you $2,003 in the next 5 years. The wisdom of the inflation hedge mortgage strategy lies in ensuring that as interest rates rise, our system will notify us to contact you regarding this opportunity to optimize your mortgage. By taking advantage of this critical timing and adjusting your payments as interest rates rise, you will not only absorb slowly and comfortably this nasty payment shock we talked about, but we will also save you $2,003. That's 10% of the mortgage principal in just the first 5 years. Now this is where things get interesting. Let's say that after your 5-year term is over and interest rates return to more normal levels and you're facing an increase in interest rates at renewal of about 5.5%. This might be the most important part of this entire video. Once you have adjusted to your $200 a month or more payment shock at renewal, you will pay your mortgage down in the second 5-year term to $159,627. However, because you've showed the wisdom to lock into a 10-year term today, of course, the second 5-year term in our example, you'll continue to make your payments as you have, your balance will be reduced to $143,276. In this example, with a moderate mortgage of $200,000, you would save $16,351. Of course, I think you'll agree with me that this is significant. For interest's sake, let's take a look at what would happen in 5 years from now if interest rates rose to the 25-year average of 6.72%. At renewal of your mortgage, the payments would rise by a staggering $340, and you would pay this mortgage down to $162,367. However, if you had taken advantage of this rare instance where the spread on the 10-year is so small versus the 5-year fixed, then you would pay your mortgage down to $130,692. This solid decision would save you $31,675 over the next 10 years on a $200,000 mortgage. I encourage you to take a moment and think of the balance of your mortgage and adjust it accordingly. How much savings might this mean for you? In summary, I think you would agree with me that our 10-year inflation hedge mortgage strategy is a solid financial wellness plan that at the least deserves a closer look. As we've established, it is a certainty that interest rates will rise. Of course, many people see the wisdom of early renewing their current mortgage to take advantage of these emergency low rates before they start climbing. However, I would encourage you to consider this idea. If you agree that interest rates will in fact normalize in the coming years, then does it make sense to renew into this environment? Of course it doesn't. Our 10-year mortgage strategy protects you against rising interest rates by thinking longer term and taking advantage of today's historic rates. The second thing we need to establish is that for those of you who are fortunate enough to get your mortgage in the past 3 years or less, then of course you are enjoying the lowest rates in a lifetime. Many people just have not considered what happens to their monthly payment when they renew at normalized rates. After this video, you now know. Our 10-year inflation hedge mortgage strategy absorbs this payment shock slowly and affordably, which gives you the comfort of being protected against a nasty payment shock. Finally, and highly likely, the most important decision you'll make to your overall financial wellness is the safe bet of early renewing into our 10-year inflation hedge mortgage strategy thereby avoiding the eventual rise in interest rates for the next 10 years. I think you will agree with me that the significant principal reduction in the balance of your mortgage over this time period warrants a strong look. I am sure you have many questions at this time, not the least of which might be, what's my best next step? Below this video, we have put a link to download a sample report that goes into much more detail about the wisdom of this strategy, as well as some frequently asked questions. Please go ahead and download that form immediately after this video. If you would like to get your own customized report and see if your personal circumstances warrant jumping into our 10-year inflation hedge mortgage strategy, then please call the number below. If you have a burning question or comment right now, then please go ahead and ask in the box provided below. Finally, if you are feeling impacted and excited about what you've learned in this video, will you consider sharing it with your friends? We never know who among us is struggling or at risk with their personal finances. What a gift you may give to a friend or family member by sharing this web address via email, Facebook, and/or Twitter. Thanks in advance. We really appreciate you helping us too.